Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, for instance, if we say, okay, if the EUI is trading 77.30, we could buy the EUI at that level and sell the January 77.50 calls for 209. So, of course, we're giving somebody else the right to take the EUI from us at 77.50. So we can also do it as I showed you there and show you the net price for that trade. Now, if the volatility were where it had been in the median for the last year, which is, towards the lower end, not in the single digits, but certainly in the lower teens where it was, well, those calls would have been more like $1.30 instead of 209. So that extra pump is, that extra bit here that we're trying to take advantage of by having that volatility be higher. So again, I don't necessarily want to buy those calls when it's at that place. I'd rather be putting to somebody else those bad odds as I view them, and having that in my pocket as protection if I have that bullish outlook on the EUI. Looking at this one, this is the same trade except as a cash-secured put, I believe, for the British pound. So if we see that, again, that rally that carried the British pound from the July levels where it's bouncing around for virtually all of 2008, the British pound to the dollar spread had been bouncing around at between 50 and 52. Then, with the significant weakening in Europe of their economies, the flight to quality here and safety over here, as well as the cuts to their interest rates being much bigger than the cuts that we can make to ours when we take ours to a single point, the foreign currency rally that has resulted with the dollar to the British pound carrying it from 50.52, again, all the way through August of this year, it had been in that range, exploding to 68 here. And so you see it there that we're seeing a reading of about 67.40 now for the British pound to the dollar, the BPX. And same as before, here's the implied index volatility, and then here's the historic volatility over here. Historically, low of 6.55 or so, high of 26.50. And that's the historic with us right now trading here at 24.90. And then over here, looking at the very high volatility of 22.51, but not nearly that panic number that we probably saw somewhere in that late October, early November time frame when it was so volatile with the British pound, and it got up to an implied vol of 32 plus. But still at 22, significantly higher than the volatility has normally been for the BPX. So in this case, whoops, says U.S. Steel. I apologize on that. I do have a U.S. Steel slide here, but I wanted to show this as BPX, so if you'll disregard this on top of the screen, I have my apologies. Instead, the BPX hovering at 50 for most of the year, and then okay, it's made this big run up here to 67. If we still had a bullish outlook at that time, we could take a cash-secured put trade by putting cash in your brokerage account, whether it's T-bill or outright cash, and then sell the Jan 66.50 puts against it and collect $1.40. So, of course, we're saying, just as in the previous slides, when the vol is high, as it is right now, and we're able to get $1.40 instead of say $1 or 90 cents or whatever it might be at that lower level, we're saying we think we've moved the odds into our favor, taking in that higher $1.40 premium against the stock that we're willing to own if it drops by about a point to 66.50. And at that slide beginning, it was 67.40. So if we look at that, if the BPX is 66.50 or higher, we of course keep that premium because we've written that premium. We get to keep it as long as the BPX is higher than the strike price. Nobody is going to put that contract to us, so we keep the $1,400. If BPX is 66.49 or lower, chances are somebody is going to put it to us, meaning, of course, that they own this insurance policy, the right to sell it to us at 66.50, and they will exercise that right and put the BPX to you. Since you've been paid $1.40 for it, your effective buy-in price is 65.10. So all the way to 65.10, you would have a winner on the sale of that put. And again, normally if normal level of protection or normal level for that put would be 80 cents or 90 cents, you can imagine then that we would be, if it were 90 cents, we would be buying shares not at 66.50 but at 65.60, 90 cents less than the strike price. Now, if you were to collect $1,400 against your $67,400 that you've got in the cash or T-bill or whatever over at your brokerage firm, you generate almost $17,000 a year from selling puts, which is a 25% return, plus whatever interest you get or whatever you funded your account with a T-bill or cash. So you have a 25% plus return from the sale of those puts. And again, we believe that the reason is that the volatility is so high, you're able to take advantage of that and put it into your pocket. So these are strategies that are very basic in terms of a covered right or a cash secured put trade, but nonetheless strategies that are keep it simple, stupid. They both have the same risk profile, folks. That particular strategy has the exact same risk profile, whether you do the covered right or the cash secured put. The payout diagram for each would be the same. So that's one thing that Stephen and I would always stress to you is people will say, well, why would I pick one over the other? Liquidity factors, that might play into it. Also, the cash secured put trade is a single transaction for that exact same profitability as the other trade is a two-transaction trade, at least on the entry, because you're going to be buying, for instance, the asset and selling a covered call. That's a two-transaction commission versus just a single transaction with the cash secured put trade, and you have put yourself in exactly the same position because, of course, the covered right only protects you to the limit of the premium you've collected in the call as well, which is the exact same as what happens here with the put.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.